Yes, thank you very much for this introduction. In Estonia, we have a saying that põllumees põline rikas, and I spent quite a lot of time yesterday trying to translate it into English. I think the best version is a farmer is always wealthy. So what we'll now try to do is to kind of understand where this wealth is spread when it comes to modern supply chain and modern trading practices, and how this is being affected by the directives and the local laws and regulations in Estonia. And also in a bit of a wider context, it's going to be a kind of a classic tale of free market and its interactions with public sector regulations, and how is this thing really going? Are we achieving the aims we are getting at? So basically, as introduced, we have 4 panelists, and at the end of the panel, let's say about 5 to 10 minutes, I hope we get some questions back from the audience as well. I promise that there will be a prize for the best question. We'll deliver it within 30 days, as is okay with the UTP directive, and the prize will likely be eternal fame and glory, if nothing else. So dear panelists, maybe we'll start with Janeli, and could you help me kind of set the scene or the stage for our discussion? What is this UTP directive, and how has it been implemented in the Republic of Estonia, and yeah, so what's all the fuss about?
Yes, very good question. Actually, before I start, I hope it's okay if I use the term UTP. I hope everyone knows it means unfair trading practices, but the shorter term is much more easier to use. So.
Yeah, instead, the Estonian version is horrible in that sense.
I don't want to talk about that. Yeah, I know the version, the name is quite hard. So don't even start it about that. Okay, I hope it's okay if I give you a quick overview what contains in the Estonian UTP law. I have to talk about a little bit UTP directive and also European Commission view, because I think it is a little bit easier to understand why Estonia decided to go a little bit farther than the UTP directive. So the UTP topic has been addressed in the European since 2009. As you see, this isn't a new topic. And as a voluntary solution didn't deliver desired results, in 2017, the European Commission launched a policy to protect farmers and food producers. Taking into account that the problems in each member state are different, they thought the best solution would be the directive. So, as most member states already have the laws restricting UTPs, they must have the opportunity to continue to implement them. So I don't know if you know that. Estonia was 4 of the member states who didn't have the law, including Netherlands, Malta, and Luxembourg. So very hard. Why are we talking about UTP law then? The food chain is by far the most important channel through which food products can reach the consumer. So the main goal of UTP law is balance food supply chain. I can't say that Estonia, these issues have not been regulated at all until now. But in Estonia, these issues were mainly regulated by the Law of Obligation Act, which actually regulates contractual relationships. So, the UTP law creates an opportunity to apply the competition authority for the protection of UTPs. So, what are the differences in Estonian UTP law? I can say that the UTP directive lists 15 prohibit unfair trading practices. 9 of them are prohibited in any event and always. 6 of them are prohibited unless they have been agreed in clear way under the supply agreement. Okay, as I said before, Estonian didn't have the law. So before we started to drafting the law, we consulted other member states and, of course, our neighbor states. And also, we involve various parties that will be affected by the law. So the discussion was almost a year long. And that's why we decided to go beyond the UTP directive in 3 aspects. Okay, let's see the aspects. First of all, we decided to protect all businesses, regardless of the size of the sales revenue. This means that while the aim of the directive is to protect smaller ones from the larger ones, in Estonia, such trade practices are in any case prohibited regardless of the size of the sales revenue. I know you want to ask why we decided that.
Yes.
Yeah, let's talk about that.
Yep.
Yeah, these trade practices, which are prohibited in any way and always, like I said, we talk about 9 practices. When we ask, okay, what is the 9 practices? Do you threat your business partner? Everybody says, no, I don't threat my business partner. Why? Unbelievable. How you can ask me like that? Okay. So, do you change the supply agreement terms? No, we are talking about, and both parties have to accept the terms. Okay, so why are these UTPs? And this is why we prohibited, no matter the size of the company, because nobody uses them. They all say that, no, I don't use them. That's why we prohibited. So, the second reason was that the determination of belonging to a certain category of annual turnover have been time costing. It is quite hard to define what category you are, how big you are. It is hard both parties, sellers and buyers. And the third reason, and probably the most important reason, was that different interest group, as I said, we involved the parties who will be affected by the law, said that the UTPs should prohibit regardless of the size of the trade annual turnover. It means, I know, sounds like the cliché, size doesn't matter if we talk about UTPs. Yes. And I want to say one more time, we talk only 9 UTPs. Mm-hmm. Actually, the second one was that the hottest one, probably a lot of discussion, was that we decided to not distinguish between perishable agricultural products and food for other agricultural products and food. Yeah, sounds easy, but the result is that a 30-day payment deadline applies to all agricultural products and food. So, sounds very simple. Why we did that? What was the arguments we did that? Sounds a little bit rough, 30-day payment. I know, it was very, very hard discussion. So, it would be very difficult to find out every time, is it perishable product or not? I can give you a quick example. Martin, what do you think? Apple, is it perishable or not?
Well, I guess yes, it's perishable.
Really?
Yeah, well...
Do you want to know the right answer?
Well, okay, tell me the right answer then.
Okay, actually, there isn't the right answer. We had discussion with other member states. I don't remember, it was about a year ago. Maybe we discussed 9 hours. Really, the discussion was apples, perishable or not. Okay. I don't remember exactly, but the Poland says, yeah, apples, definitely not perishable. Really, try the apple, Poland apple. Yes, winter apple. Come on. No, not perishable.
Okay.
Okay, then the Spain raised the hand. Really, apples? Have you tried them? Oh, come on, it's perishable. So what we do now? And there is no right answer. 9 hours and there is no right answer. And that's why we decided, since there are no specific criteria for determining perishability, and it would be very, very expensive and time-costing to make sure is it a perishable product or not. And the third reason, and the main reason actually, was the 30-day payment deadline is common in Estonia. Yes, they are asking, why, really? Yes, the average payment for invoices in Estonia is actually 16 days. And if we talk about the European Union, the average payment deadline is 34 days, sorry. So Estonia is not the only one who decided to abandon the definition of perishability. For example, Germany, Sweden, Czech Republic. And maybe the best example is the Finland, who decided that they use 15-day payment deadline for the fruit and vegetables.
Okay. So it's all really interesting. So basically, to kind of try to sum it up a bit, what basically we were trying to do with this law is, we'll take the UTP rules as they have been, let's say, adopted on the EU level, introduce them in Estonia, taking into account that, we want to, let's call it, establish a fair moral ground where, what is not morally or ethically okay is not okay. Number one, and number two, if I'm not mistaken now, the underlying thought behind it all is that we'll try to make it as easily usable and implementable as possible.
Yes,
so we would not have an argument whether Apple is with you forever or only for a while.
Yes, of course, and actually we consulted with the Latvia, and our colleagues said that the most cases is about how big the company is. So they don't argue if they use UTPs, if it's okay to use UTPs. They argue, okay, how big the company is. Is it bigger than the other? So they don't argue the right reasons. And that's why Estonia decided, okay, we want to argue, is it okay to use UTPs or not? No matter what, no matter how big your company is, we all understand, we all agree, it's not okay to threat your partner. It's not okay to change the terms of a supply agreement. We all agree that. So that's why we decided that it's not so expensive and it is easier.
Okay, I understand. We have quite a good basis to go on from here. Whether we all agree with this one is a different story. Being maybe on the other side of the table every now and then. But Marika, as we already entered into the Latvian regulation, how did the UTP directive affect Latvia? And I understand that there the regulation is a bit older, with a bit of more historical background. So maybe you can enlighten us on what's going on in the southern neighbors' jurisdiction from Estonia.
Well, weather is the same as in Estonia. So from
unlucky for you.
Yeah, but in Latvia the situation is a bit different in the sense that in Latvia this UTP regulation was introduced into our laws already back in 2008. And this development was very long, and during this time, of course, the law has changed several times, starting from the fact that the initial regulation was implemented in the framework of classical competition law, and then later on, in practice, the authorities understood that there should be a separate law because competition law is like something for itself. So yeah, later in 2016 there was adopted a separate law for unfair trading practices, which later was supplemented according to directive. Yeah, so from that perspective, the Latvian market is kind of used to this kind of rules, and all the battles took place back in 2008, and there was a lot of discussions, of course, and so, but yeah.
Basically, everything was settled by the time Estonians started, reading the directive, yeah?
Yeah. Maybe the difference from the classical UTP directive is that in Latvia we have this differentiation between food sector and non-food sector, because in Latvia also these rules apply to non-food retailers, but there is a little bit peculiarities about that part. So, but the idea is the same.
So basically, there's something to the saying that, what I understand Latvians are saying that the Estonians are a bit slow. We might have an example here. But when it comes to real implementation of the law, has it led to a lot of, let's call it dispute, investigations, a lot of, changes in what's happening really in everyday Latvian practice, how the, retailers and producers and others are kind of interacting with each other? Is it...
Yeah, as I said, since we have this history quite long, then it took some time for the market to adapt to this new regulation, and I think when back in 2008, when the law was firstly adopted, there was also some transit period where the Competition Council said that it will not start fining, but will consult. So actually, this first year was used for consultations. Many of market participants went directly to the competition authority and asked to explain the law, and also competition authority has published several versions of guidelines explaining how it will interpret the law. And also we have a possibility in Latvia to go to public authorities and to ask for official opinion. It's called statement, and it means that if you apply for a statement or official opinion, then the authority issuing such is bound by its opinion given. So that tool is also frequently asked, and so yeah. But what I can encourage parties doing business in Latvia should also try to consult with competition authority, because our authority is quite open for discussions and consulting, which is good.
Okay, clear. Now, Olivier, if we now move from, let's say, from the Baltics and kind of try to see a bit of a bigger picture in the rest of Europe, I understand that in the Netherlands there was no, let's call it UTP law beforehand as well, before the directive, and now it's there. Has it really changed anything, and how actually has the directive been implemented there?
Well, it's a short answer. The answer is no. There was no impact.
No.
So sorry to disappoint you on that. So that's a short answer. No, it was, I think, introduced in November 21, so about 2 years ago. And I did some research on this subject because, to be honest, I didn't know what UTP was. In banking terms, it's unlikely to pay, but that's somewhat different. But still, no, I think you must look at the Dutch market. So it's pretty much consolidated and also integrated, more or less. So there are not too many small farmers or small parties actually selling directly to retailers. So none of the change was affected by this law. But then again, there's another thing maybe. I mean, if people are talking about whether an apple is perishable or not, it's more of my liberal background maybe. But I don't like regulations too much. So if we're trying to, you cannot disagree with things being unfair or fair. I mean, it's unfair to pay somebody late, and you should pay within, let's say, 30, 45, 60 days. But eventually, it's up to the market and up to the buyer and the seller to draft the contracts between the two of us. And we should not need governmental interference or European interference from our point of view. But now I understand, being here, that the situation here in the Baltics was different. And I think it can contribute maybe to ease up the value chains and to ease up the supply chains. And therefore, we can provide liquidity if it's needed.
Okay, so basically I understand that it was implemented. nothing really happened. The Dutch people aren't still debating what, how long the apples are edible or not. Life kind of goes on.
That's right. That's right. I understand that there have been 2 complaints in 2 years with the authority, probably of 2 people fighting over something else. So yeah, it was kind of adopted.
Okay, but I understand then quite likely that the directive was implemented without these restrictive approaches taken, for example, in Estonia. So there's
It's restrictive. Yeah, okay. It's restrictive. It has everything that probably that you have. But the impact of it wasn't that big. So apparently, I mean, the food retail in the Netherlands, although they rely on fresh produce. So if you don't have the apples and if you don't have the fresh meat, then you can close your shop. So I think that's so in the agreements between the suppliers of those products and in this case the food retailers, there are agreements being made on the payment term, and they were probably closer to or maybe below 30 days than more above them.
Okay. So basically, it kind of seems that as it kind of depends a lot on what's the actual, let's call it business culture or the trading practices or the, let's call it market equilibrium that you have reached beforehand.
Yes.
Given the availability of capital and the companies involved there, that already had led to a situation that we are now trying to get to with regulation.
Well, in the end, I think I was talking to somebody here, and he said, well, we were perfectly fine with an agreement of 60 days between ourselves and the supplier of fresh produce. And now the law obliges us to do something about it. And it puts us in danger, us being the buyer, and the supplier is perfectly fine with the 60 days, so why bother? So I think you should maybe decide how to use these regulations and why it was implemented. And if it is by protecting the small farmers and protecting any small or SME companies, I think it's perfectly fine to do so. But the impact could be somewhat different maybe than that we all expect or expected.
Okay, so the unexpected consequences here. Maybe now moving then, given that in the Netherlands we don't have anything to do, so thank you very much, we'll see you next year. But Hele, given, your background as a supply chain, let's call it enthusiast, when you've been within the discussions with, let's say, the retailers and that sector, what's been your impression on, has it been as benign in Estonia, has it been in the Netherlands, or are we facing some other headwinds in the let's call it retailing sector in Estonia? Until we are experiencing technical issues here, maybe we move to Martin here. We come back to you. We'll come to you. Once you get the technical items solved.
See you next year.
Yeah, see you again next year. There will be a party in the evening, and I hope you love it. But Martin, given your background, you come from a, let's call it a vertically integrated food producer, and as you once said, the largest farming company in Estonia. Is everything hunky-dory nowadays, given the UTP directive and all your problems have been solved, or how's it really have affected the business of HKScan in Estonia?
I think if you take a look at the net impact, then it has been negative. Because I would, of course, commend the Ministry of Rural Affairs for trying to make a piece of legislation that's universal and that doesn't differentiate between large and small players, because that is also often the problem that we face, for example. But definitely we ended up losing, let's say, 7-figure sum in cash flow thanks to the application of this piece of legislation, because it didn't really impact our sales side, but did have an impact on the purchasing side. So if you talk strictly finance, then quite clearly there was a kind of a month when we had to pay 2 months' bills at once. I would say there were also some other problems that maybe arose from the unclarities of the wording in the legislation. Like, for example, we were wondering what is the meaning of goods being consumed inside your own company. Like, for example, if chicken eat the grain, is it consumed or not? Apparently it's not.
What do you do with it then?
It is, well, it disappears, but in the sense of in the legal sense, it is not consumed, at least for the purposes of this legislation. And also us being an international group and on the sourcing side, relying a fair bit on group-wide synergies and group-wide knowledge, then actually the fact that this a directive is implemented in a different way. Of course, I understand it's not the fault of the Estonian officials, but that also led to some misunderstandings, like, let's say, spice mixes fall under this legislation. I think it was in Sweden they fall, in Finland they don't. Then it's the question in Estonia, do they or do they not? Okay, they do. But then if you think of spice mixes, then, for example, salt doesn't, because it's not an edible thing, but it's a natural resource. So there are a lot of these kind of interesting questions that until you really start discussing how to apply it and with whom, what contracts do you change or what terms, until that it looks nice on paper maybe and the intentions are good, but my feeling is that the intentions have not been achieved.
Okay, well, but if you're going to dig into this a bit, so salt is not covered and so on, and you're also explaining that when it comes to the sales side, so basically selling the goods from your company, let's say to Selver or other retailers in Estonia, they more or less, left things unchanged. So it's close to what we saw in the Netherlands, yes?
I would say yes.
Okay.
Yes. Well, of course, I'm speaking only on behalf of my experience or our experience. Might be that there are some suppliers that did benefit from it. I don't know what they face on the other side. Mm-hmm. Okay, was there win in net or not?
But then when you mentioned that, okay, we have a negative 7-figure sum there, and that's coming from the purchase side, could you kind of then explain what was going on there? Did you have did you apply, I don't know, very long payment terms for your suppliers then, or?
Well, first of all, we are a large company, yes, so the overall turnover is such that if you change the payment term by let's say from 60 to 30 or 45 to 30 or whatever the arrangements were there, then you end up having this one-time cash outflow of maybe, let's say, a few million, maybe a bit less. And of course there are large parts of our business that are not affected, like in grain trade, the payment terms are very short and so on. But I think it was actually mentioned in one of the earlier panels here as well that some suppliers that can consider it as their competitive advantage to offer long payment dates. Mm-hmm. And we were definitely taking advantage of that, knowing that meat business is not particularly attractive, profit-generating business currently in Europe. I think that's how the situation played out.
Basically, what you saw in your business is that the payment terms for your suppliers, they were shortened as a result of this law, leading to kind of a loss or problems in capital or cash flow management there. But wouldn't an argument there be, or at least I would guess that Janeli from the minister's side, yeah, sorry for speaking on your behalf now, is that, but guys, that is specifically what the law was meant to do, that, big companies like, HKScan would not be applying overly long payment terms for the poor farmers that are supplying your business there.
Yeah, but these suppliers that we are talking about, these are also large multinational companies, so I think they were quite happy, and there were definitely those cases where there was no incentive from the supplier side to change the contract, that we see that we have to comply with the legislation, therefore we initiate the change in the contract terms. And I think actually it would be the opposite in those cases where we interact with let's call them small farmers, yeah, although in Estonia I think most of the animal husbandry is anyway relatively led as business rather than family farms as it is in some other countries in Europe. there, for example, we are one of our pig contract models is such that we sell piglets to farmer for them to grow up, and then we buy back the fatteners. And there we had a scheme where we grant a long payment term for the piglets so that their cash flows would match when they get the settlement for the fatteners. And now we are kind of not allowed to do that.
Okay.
So
basically, for them now you have to apply the 30 days and.
Yeah, actually, yeah, our company has such a long supply chain that I don't know the exact terms in every transaction that we make, but that is a place where there is a problem.
Okay.
And I don't think that was the intention of the legislators to.
Yeah, okay, maybe. But now, given that Hele might be wired up again, are you with us?
I am.
Yeah, okay, that's good. Yeah, and technical issues, this happen. But maybe moving back to kind of the comments you were trying to make about the retailing one. We see that we have some maybe let's go to unintended consequences in the food processing business. How does it look from kind of your angle there?
And even before going to the retailers about supply chain finance. So first I will talk as one person and then the other. And the first person is my hobby has been for the last 20 years to teach corporate finance at the Estonian Business School, at Tallinn University of Technology, and some other places at bachelor, master's, and executive level. And so when you teach finance, you talk about working capital, and you talk about how you should optimize working capital, and the ways of doing that is to try to get your buyers to pay as fast as possible, and try to pay your own suppliers as long as possible, since you don't want to have your cash tied up in working capital. About 10 years ago, one of the master students did a master thesis on supply chain finance, and that's how I kind of got to know more about supply chain finance, and I really loved it. And it was a pilot program in one of the Estonian technology companies offered to their suppliers, and she did like how did it go and what went well and what not, so it was very interesting. And coming back to maybe last panel's issue of is it easy to do supply chain finance and do companies know about it in Baltics? And the answer is no, they don't know about it, they don't understand it, and should we teach it? Yes, we should. Should we train and talk about it? Yes, definitely, because it's a really cool concept. And how I explain it to a very people who have never heard about it is that, and I also teach supply chain management. So at Tallinn University of Technology, we have a master's program in supply chain management. And in supply chain kind of view of things, you think that it should be fair and that the supply chain should work together. And putting those two things, finance and supply chain working together, would mean that the supply chain gets financed by the cost of capital of the strongest member. So this is what the supply chain finance is all about, and we don't know about it, and it's difficult to understand, it's complicated, but it's cool. So at Tallinn University of Technology, we actually had 4 years, a whole course on supply chain finance. At the moment, I just checked, it's not there anymore, but just building on last panel's things, I got all those ideas today. I asked the head of business administration whether they would love some supply chain enthusiasts to come and teach. Yes, they would. So any of you who are service providers or financiers, you're welcome to and go and teach about it and talk about it. But coming back to the UTP and retailers and working capital management and the cost of capital, I also didn't know much about UTP before one of the retailers called us, and now I'm the second person, which is EDI service provider in Estonia, where I work daily. And they asked, can you help us? And we are EDI service provider, meaning that we help companies exchange orders and invoices. And no, we cannot help them because that's not definitely our business. However, then I learned about it, and I asked retailers, and I called retailers and asked how were they impacted. So finally coming to your question. And I was very nicely surprised how quite a lot of retailers actually said that they didn't have a big problem because they already had short payment terms with food producers. And by the way, the whole discussion is only about food. Yeah, I also didn't realize that at first. I thought everybody has to pay everybody in 30 days, and that would be the end of supply chain finance. But no, it's only food, and it's only in some countries perishable, and in some countries all of the food anyway, agricultural food. So first of all, it wasn't a very big problem, but secondly, it actually was definitely a problem because the retailers had to redo some contracts, and if Martin from HKScan said it's a 7-figure problem, then today I can say that it's an 8-figure problem for the retailer sector as a whole in Estonia, definitely, meaning that they had to somehow now finance more working capital than ever before. So yes, it is a financial problem, definitely. And kind of getting philosophical is that was it necessary? Wasn't it kind of solved before through all kinds of financial instruments? Because we have had factoring, we have had everything. And yes, there's the cool supply chain finance stuff, which of course hasn't reached Estonia, not so much yet, or Baltics. So from the supply chain finance or like philosophical point of view, I think that, okay, now there's more incentive of the retailers to think about those supply chain finance programs and be more open to all kinds of new instruments. But other than that, the first reaction was that, okay, if they make the payment terms shorter, then it's not going to be free. It's anyway, the total cost in the supply chain will still be the same for the capital, and it would only make sense to for that supply chain member who has the best cost of capital to be helpful in acquiring that capital. Too long answer, but kind of really interesting philosophical question on top of the food and piglets, and I love the piglet story. Yeah. Mm-hmm.
Okay. Yeah. But basically, what I'm hearing a bit from Martin and Hele is that we're seeing a somewhat increase of costs for different participants in the supply chain. Are we speaking of 7 figures, 8 figures? How many figures it is. What I'm kind of struggling to find a solution or answer here in this lawyer seat at this side here is who's paying for it all. If this cost now, is it something that's kind of a new cost in the supply chain? And if it's a new one, then who's buying it, is paying for it? And if it's not the new cost, then who's, from whose side is it coming? Maybe Olivier, you as a banker.
Yeah. Well, eventually, as everything in life, the strongest is not to pay. So it will be calculated somewhere in the price, and apparently somebody will pay, and it will be the supplier, I think, in many cases. But I think the discussion here is pretty interesting, because it's not about cost, so sorry for the 7 numbers, I don't like that, but it's the cost of liquidity. It's not just the cost of liquidity, it's also the value of it. So somebody pays for liquidity, and the supplier can go to a bank and to finance upon the receivable, as Sean just explained, and the buyer can go to his bank and try to find a supply chain finance program of some sort. But in the end, banks or financial institutions, through those platforms like Supplier Plus, will be able to finance the liquidity and provide liquidity to the chain. And that is up to, I think, the individual chains within the total value chain, who's picking up the bill. So what's the value of the liquidity for each part of the value chain? But I think in the end, it is cost, yes, but it also relates to the level of cost compared to your own cost. So if you would go to the bank yourself, being a small supplier, the bank would charge you maybe, 5%. And you might now have the option to finance against 2% because it's related to the risk of the buyer. So it's a matter of cost, but it all depends.
Okay, so basically, what it seems to come down is that, if we have the model of the supply chain working in a way that you have a big retailer, no names here, just in case, and then you have a small family-owned farm, where in this case, the family-owned farm would have, let's call it the worst credit rating or, credit availability, highest interest rate there, then, it all starts to make sense. If on the other hand, you're entering into a world where you have, big box of being a producer or supplier, and as a large box being a retailer, then it could be a bit of a different game there, and the cost might be more cheaper for the supplier then, or.
I don't know, it depends on the boxes, I suppose.
Okay.
It's kind of theoretical, but I think that in general, the market itself will solve this. And we don't need regulations or regulators to take care of this commercial issue, whether it would be the cost of the liquidity or when to pay, at what date, and whether it's perishable, yes or no.
Okay.
So in the end, but that's more of maybe my liberal background, but I think it's not just the additional cost that is to be borne by somebody. I think it's the value of liquidity, and somebody will pick up the bill if they think that the offer is right.
Okay, yeah, it all makes sense. Janeli, kind of giving all this feedback, is it something that was kind of collected and received as a feedback when this law was prepared by the ministry, or is it just something we could call now as a kind of a afterthought that's now becoming aware, these types of questions and issues and so on? And what's your general comment on what we've been discussing here?
Yeah, very hard question, I have to say that. But when we're drafting the law, I can say it was very hard exercise. As you hear, everybody, we have a farmer's side. We understand they have to pay bills. 30 days, you have to pay electricity. You have to pay the workers. You have to buy the animal food. Yes, we understand you have to pay 30 days. So that's why it's important to get money to your product. Okay, so we have to also food producers. They also have payments. They have to do the investments and so on. So yeah, it was very hard to see what is the best way to draft the law. And I want to say that no matter what kind of law we're talking about, no matter what, there are always winners. I don't want to say losers, really, but sometimes someone loses. But I heard HKScan. Yeah, I'm sorry about the figures, but I think we didn't analyze, or I don't know, maybe someone analyzes who paid that before. So I don't know. Before, maybe the farmers paid all the costs. I don't know. But yeah, it was very hard, and let's see.
Yeah, okay, Martin, given that you have the losers chair.
I would like to reflect. Maybe I'm also too liberal in that sense, or but I really like this. Let's call it theoretical approach that the liquidity will be provided at some cost anyway, and the free market will direct cash flows to points in time and between individuals, wherever is the real market force. And then any legislation that you introduce can already by theory only make things less efficient, because you will need one or two more of these transactions. This is still very theoretical, yeah? Likely there are frictions in real life that don't really allow it to happen really as efficiently. Therefore, there will be, some actual winners and actual losers, and maybe banks will be able to earn more on their interest revenue. But in that sense, I would subscribe to this Dutch liberalism.
Okay, but now we're in a bit of a, let's go with the theoretical, nice Adam Smith type of a world that, we have, graphs and stuff, making, kind of an argument this XYZ option is something that makes sense. But maybe Oliver and Hele, could you, let's take an example of a family farm who's kind of supplying, goods, let's say potatoes or apples, let's have them perishable as well, supplying them to a large retailer that, sets a payment date of, 90 days. What are the real options, leaving aside this law here, let's say that the world is, Dutch liberal, nice utopia here. What are the real options in today's world for that farmer there to solve the liquidity problem, and how much does it actually cost for the farmer? I know which of you wants to start first.
Yeah, me? Thanks. From a practical point of view, then, you can do the more difficult one. So there will be two options, in fact. One is that the supplier will approach its bank and to ask them to finance upon the receivable that he has on the retailer. So that's the 90 days. So what a bank then usually does, they value the receivable and they relate a certain risk or a certain price to the financing that they can provide on that receivable. And in many cases, in this case particularly, so the family business is probably having a lower credit rating than the buyer has. Let's assume that. So maybe they would get access to those funds and they will be paid. So they will get a loan based on that receivable for 90 days against a certain percentage. Let's say it's 5%.
Okay.
I think it's perfectly fine if they are able to approach their financier. That's fine. It could also be that their financier says, well, we financed your farm and your wife's car, I don't know. So it's been enough. So we don't want to finance anything more on your business. Well, then there you are. Then you have to wait for 90 days. Now the alternative is that this retailer has a supply chain finance program whereby the retailer or the suppliers of the retail have access to a financing solution asking for prepayment of the actual receivable. And it comes in various forms, but what in fact happens is that a bank or a financier prepays the payable. And at the end, so at 90 days, then the retailer is not to pay the seller anymore, but is to repay the bank. And then there's a small margin in between. So the margin there would be, let's say, 2%, because it's not based on the weaker family farm, as you just described, is based on the performance of the retailer itself. So, yeah, I think there are two ways.
Okay. Hele, anything to add there?
In theory, absolutely. But they are getting a bit more practical. So let's, again, commenting on how many farmers actually trade directly with retailers in Estonia, Latvia, or Lithuania, very, very few. But I do know some. The retailers themselves have said about 2 to 3% of all trade is directly with farmers. And also there was in last panel, there was about questions about technological solutions. So actually, yes, I remember that we are also in fintech. I thought that we are not, but yeah. So Telema is the one mediating the orders and invoices between, in Baltics, 5,000 shops and 1,500 suppliers. Every year, 25 million documents go through our system. We convert the documents into the format of the receiver, and everybody gets automated data into their systems. Now, we actually have had also e-factoring. Well, we are still only the transporter of documents, but with Swedbank, for over 15 years, there is the option of sending a copy of invoice to the bank as well every time the invoice is sent to the buyer. And also now it's with 5 more banks operational daily, so that the kind of like traditional factoring has been already there for a while, and it's really also technologically easy to use and so on. But yes, I was kind of hoping that the supply chain finance could also be an option, because it has better benefits for both sides. The cost of capital will be lower and so on. However, when I heard about the UTP, then I thought, like, okay, now that's kind of over. But what I was glad to hear is that exactly those programs, like we knew them, maybe are not suitable anymore, but there are already new models in process and integration, not by us, but by Supplier Plus, for example. So there will be options also in the future, but yeah, kind of coming back to the belief in the market, free market, and the business parties being able to actually agree on terms between themselves without regulation. it's just, I mean, and I really love your passion of everybody understands that the farmer needs to feed his sons and school his kids, and everybody believes that. And it's no problem. And actually, towards the farmer, maybe the biggest missing part was to first research whether the farmer really needs help in terms of payment terms or not, because it sounds like they didn't, and it might be that it's now worse. And there's a lot of bureaucracy and reorganizing of processes until the market reaches again some sort of like everyday working condition. So that could be my short.
Okay, so basically we seem to have a kind of a solution for the little farmer who might exist, might not exist in the Dutch liberal world. What about the worry of Martin here with the loss of seven-figure sum due to liquidity issues based on, let's go with the Brussels model, maybe that's kind of the closest option. The neighboring countries, it seems, but are there any solutions to kind of reduce the costs? When you start thinking of it from supply chain financing, banking side, to reduce the large cost that the vertically linked producer, as we have in the case of HKScan type of a company, is there anything to make their options easier in this new post-liberal world? Maybe let's go it this way here. Olivier?
I didn't catch your question, to be honest.
So to be honest, the question is, are there any options of different financing products when it comes to supply chain financing where the costs of, for the producer who now has to bear basically the costs of supply that otherwise was kind of distributed by them, they had longer payment terms, now they're short-term, there are some issues there. Is there anything that can be kind of done that really makes that thing whole as well and as efficient as possible?
Yeah, well, again, I think it's the access to liquidity. But maybe Martin, it's up to you how you look at it. So I think yes, there are. I mean, there are a million different solutions to sell to either the buyer or the supplier. The only thing is that it's kind of capital or not capital. It's kind of intense, providing all the documents as you just said, and complying to all the rules, obviously. So I think that's the most or the best solution here would be, in your case then, to have some kind of a program on your company giving access to liquidity without interfering with your working capital. So maybe to keep the 60 days and to pay after 30 days or maybe even after 1 day according to the wishes of your supplier. I don't know. That could be something.
Okay, makes sense. But if you now maybe turn to the Latvian side, we have a new regulation here, a lot of heated, well, not heated, calm Estonians here. A lot of kind of ideas back and forth on different models of how things work and not. When you look back at the practice in Latvia, has there been any kind of debate on how this, UTP laws that you have had in force for a while now should evolve? Should they kind of go more restrictive, become more liberal? Is there any smaller changes that are thought of, or is it kind of a thing that's now has been set in stone and there's no debate on what to do, what not to do?
There is many questions in one, but yeah, first of all, I think our competition council is the main body which is explaining or interpreting the law, and of course courts following competition council. We have had during these years several cases where the retailers have received fines for breaching these laws, and of course always there's discussions around whether competition council has interpreted it correctly or not. But the main, mindset behind this whole regulation from the competition council side, and it is not changing its attitude yet, it always declares that in this UTP regulation context, there is now equality of the sides. And that is the point from which any further activities follow. So no equality, it is a presumption. And whatever is reality, it can happen that there is like HKScan example, yes, where there's a big supplier versus big retailer, and they are equal in a sense. Still, the competition council says or interprets the law that there is no equality. And it of course makes this discussion harder. But one thing is maybe a little bit easier in Latvia compared to Estonia, that we have this division between perishables and non-perishables, and then for perishables there's 13 days, and for rest of food and agriculture products there's 60 days, so there's a little bit more freedom. But also the Competition Council has quite recently published an article or short guideline saying that it really appreciates different financing models and schemes, and including also supply chain financing models, as it sees it as a good solution for these liquidity issues. But it always stresses that you can choose whatever model you want, but supplier must get its money from the retailer within those deadlines set by law. Mm-hmm. So if this is followed, then any model is fine, according to explanation of Competition Council.
Okay, that's quite interesting in that sense that there's still some leeway within that system there to make it work for kind of to make it as whole as possible. But kind of thinking this idea further, we in the EU level there's a plan or consultation at the moment to change the so-called late payment directive and kind of to oblige or make the receivables even more freely tradable. So basically, whatever the payment term is there, it would be easiest, and without any problems you would be able to hand it over to whoever the financier could be. Would this maybe kind of the other way approach, that we take regulation and try to kind of increase the freedom within the supply chain to trade with different instruments? Is this maybe a kind of a solution that helps the small farmers, helps the HKScans, and in the end the retailers, and then potentially leads to lower shelf prices as well? I don't know, what's your feeling, Martin, on that one there? Given that you're in the kind of a center of this whole here, and not only on this stage, but
Well, I think in general more flexibility should enable more options to be employed, and maybe then make it easier to find to put liquidity provision on the party that has the lowest interest rate in the end. Mm-hmm. How exactly it would work in practice, I don't know. I don't have any experience.
Maybe I do have. Maybe, but the role of the credit insurer in that. I mean, there could be ways maybe to substitute the risk of the transaction as such, or of the receivable as such, by including a credit insurance. But that also, I mean, that's engineering. So that's another conference, I suppose. Yeah.
Okay. Well, organizers, keep that in mind then. But Janeli, from your side, listening all of that one, is this something that could really work for these issues that the Ministry of Agriculture and basically the drafters of the UTP directive were kind of having in the back of their head, different options that are being solved? Would it really be usable in practice, from your view?
This is a very good question, and actually I don't know how to answer. Because I think it is maybe too early to assess the impact of the UTP law. Mm-hmm. We have to wait a little bit, and maybe then we can thinking about changes. We just have to wait a little bit. But we also examined the implementation of the UTP law from other member states. And some member states have indicated that they are also planning to reduce the payment deadline. But I don't know yet, because everybody right now is struggling. They just want to wait and see the impact.
Yeah, I can tell you from the lawyer's side, it's a very good law. Led to, a lot of billables there. So thank you very much for helping the sector in need. Let's put it this way there. Let's maybe turn for a moment to the audience here. Do you have any comments, questions on the debate questions at this stage? Yeah, should.
Yes. So just by way of a comment, and this is going back to what Martin was saying about after the late payment directive comment as well. So in English trade finance, from what I've learned in the past couple of years in the business is that there are bills of exchange that the buyer can attach to the invoice, and that makes it very easily tradable. So one kind of regulatory approach is that if you want to maintain short payment terms, then we encourage buyers to do that. But if it aligns with their business needs that it should be longer because they need to kind of reduce their cash conversion cycle, then one could require them by law to attach a bill of exchange to that invoice. And now, as long as that buyer is bankable, the invoice will be sold if the supplier so chooses. If they don't choose it, then that's fine as well.
Yeah, that's a good comment in that sense there.
Yeah, just to ask a question, I sort of raised it in my presentation before, but what I'm seeing is a lot of, because of this, because of the unfair trade practices or late payment legislation, some buyers are moving away from using invoices to finance, whether it's a buyer or seller, and actually moving more towards sort of prepayment structures. So you're nodding there, I can see that you've seen this. And that, in their view, gets around the legal problems triggered by the directive, which are triggered by the existence of the invoice. So don't have an invoice, simply have a payable that, as I was alluding to, can, with a bit of counting magic, is neither bank debt nor trade debt. It goes into yet another third bucket. Have any of you seen that, and do you think that's a good idea? And leaving aside the accounting stuff, but I can see some nodding there.
Well, it's a good idea because it would mean additional business, I suppose, for the banking and for the lawyers to come up with that. But I think, why are we doing this? Trying to find a way, a detour to overcome regulations. Yeah, I mean that's what's happening.
That's what's happening. Yeah, it's a legal / accounting workaround.
Well, I think in general it's not the best solution, I would say. So it would be better just to have it old-fashioned, just payable or a receivable with a payment term. That's it, in my opinion.
Yeah, I agree. I mean, it's just something which is quite new to me, and I just think there was experience from the panel on it.
I actually haven't seen it before. I have a couple of calls now to make after this panel here. But I think from a student side, I think it's a bit too early. Maybe it's still being worked into the system, so therefore it might not really have happened. And second item is I think it works for the large trading partners there between them, and then you have to have significant sizes to really be effective there.
Yeah, it's something I've seen in France where the directive is also quite strict.
I could maybe comment that, yes, if there's a problem like UTP suddenly coming into force, there will be solutions, and some of them are better than others, and also we were asked, like, could we do something magical, like renaming, just like something like, it's not an invoice anymore. But I do agree that that's not the long-term solution, and that was definitely not the point of the UTP, that the buyers will just find a way how to kind of avoid the payment, or kind of find a way to prolong it so that the supplier actually doesn't benefit. So that wasn't the point, but yes, when there's people are very creative and find solutions, and I guess what we can do as the supply chain finance community is to find kind of legal and ethical and workable and efficient solutions. Yeah. And I'm sure that there will be those, but I'm just a little bit sad that perhaps it wouldn't have been even necessary to look for solutions if there actually are already quite okay solutions, and now we just have to kind of go behind and find ways, just because, which will kind of come to the same point, but just after some work and some fees to lawyers and banks. Mm-hmm.
Yeah, lawyers are doing quite well out of this. Which is not a good thing. I say that as a lawyer.
Okay, thanks. Anything else from the audience?
Yeah, in the back. Yeah.
Sorry. Okay, yeah. Sorry, it's the lighting here. That's kind of a...
Thank you. Reflections from the other side. So I'm of the few corporates representing here, and I'm from Coop Estonia. So yeah, I would really like to comment that regulation. So Coop Estonia is a cooperational business format. So we represent around a quarter of the groceries and essentials retail market here, and I think our group in Estonia was one of the groups that was the biggest impacted from this regulation, I guess. So maybe our competitors did not have such good payment terms, but we were impacted, and I guess this 8-figure number comes from our side as well. So this UTP regulation in Estonia, so it's really, how to put it mildly, one size fits all, but it never does. And the question is what we really want to regulate, what we want to impact. And you cannot really impact everything with such a simple regulation. I've been in a finance a long time, and also working in companies where we had to implement the SOX regulation. Do you know what is SOX regulation? It's Sarbanes-Oxley Act, 1 page, which is simplified regulation that generated whole consulting industry worth of billions and billions. So not comparable, but a little reflection and comparison this one. But to come to the fact, what is the impact to the retail business? For sure, we understand the regulation, why it's called into action, and what is it meant to regulate. Of course, and I truly believe that we should support small producers, producers of the essential goods, especially food. Now in the European Union level, we are talking about the food security, and the small producers have a huge part of this, of course. And it's also good to hear that, for example, HKScan, probably HKScan is soon to be part of the MAAG group in Estonia, which is the largest food producer and manufacturer. And the other leg of the MAAG group is a farmy dairy production. And farmy dairy production is a main dairy products partner for the Coop group in Estonia. So supplying quarter of the market. And and of course HKScan is a very big supplier for us as well. And it's really comforting to hear that on the sales side you had no effect. So it means that actually for this food production, for this quarter of the market, retail market, retailing, market actually works. So no over-regulation needed. So it means that if there are fast-moving consumer goods, especially dairy, meat, etc., really perishable products, so nobody would ask a 90 days payment term because it doesn't just make sense. So it means that market actually works. On the other side, Coop is also very responsible. It's a cooperational business format in Estonia. And we actually, our statement is that we are local. We don't have single owner. We have 60,000 customer owners. And at the same time, all the profits are reinvested into the communities. Also, through these programs that we onboard local small producers. We give them very favorable terms. We give them space in the stores, etc., so that they can, experiment, get the market presence, etc. So we are doing that already. So and it's very appreciated, and we will continue to do that. Cost of the change. So we started to really look into this almost a year ago. Totally different interest environment. Up to today, we have quite favorable rates, as a big company. And up to today, I think the cost of working capital financing has, the rates have doubled, almost tripled. There's a cost involved in this. Who will pay for it? I think customer, eventually. And that's the fact. Whether you want it or not, eventually, that comes down to the price indexes. That is one of the additional input costs, etc. And unfortunately, that also a bit puts the pressure to the consumer indexes, etc. But of course, it will, fade in the structure eventually. But there is a cost, and such kind of regulation creates unnecessary efficiencies in places you could never imagine. For example, we have hundreds and hundreds of suppliers. Number of suppliers are supplying food products, non-food products, and then just to split the invoices for this one supplier. Again, to do that in very correct way, we would need a couple of accountants to add to our team. We'll probably not focus on accounting services. So again, we cut corners. We agree that, okay, let's say majority of your products are food products, and okay, let's put 30 days. And again, on the non-food, we lose working capital, we have to finance it, there is a cost on this, on top. That's the life. And when we come to this, really the products, again, one size fits all, never. Products are so different from their qualities. Their shelf life, their, turnover, their whether it's essential, whether it's luxury, it's totally different world. So to support small producers, essential food products, yes, I think we need to do that. But actually now, most of the companies that are benefiting from the regulation are tobacco companies in Estonia, then expensive, strong alcohol. Was that the aim? Definitely not. So there are huge side effects which we cannot foresee, which we cannot anticipate, and therefore this kind of simple over-regulation is really, we should avoid that.
Yes, thank you, Veiko, for that
simple conclusion.
Sorry, I have to kind of stop you here because we've been running out of time and there's others who want to...
Can I add one thought, very short?
Yes, okay, go on.
As a glove to all the fintechs in the room, so usually we think in terms of payment terms, that what are the payment terms of a supplier? But as it was pointed out, it can be that from one supplier you get non-food, and then part of these are under this regulation, and part are not. And modern, or like today's IT systems or programs, usually not, you cannot make that kind of differentiation. Like you have one supplier, one payment term, so that the payment term maybe shouldn't be connected to the supplier, but rather the goods supplied.
Okay. So basically, we're going to just, stay on the stage here. So no way of getting us out of here. But let's do a very fast lightning one. One sentence, as a summary from everyone here, and then, we'll be gone, I promise. Let's start here.
Maybe over-regulation.
Okay. Marika.
Yeah, maybe over-regulation, and there should be a little bit, not so formalistic approach, because there is case by case actually behind each case.
Yeah, Martin, you got your sentence already. Janeli.
Okay, thank you. I think the main goal for the UTP law is balance food supply, and I can guarantee there to discuss or find the best way to do that is very, very hard. And we try to do that, but let's see.
I agree. And Hele, you get to sum it all up before we are driven out of off this stage.
Let's talk more about supply chain finance.
And on that bombshell, thank you everyone for listening and participating. And yeah.